This next section is dealing with the audit of the superannuation fund. A number of clients have acted indifferently towards me with respect to some of the outcomes of the audit, and so I thought it may be prudent to cover off with you some of the things that are important within an audit, and sometimes why my hands are tied as to why I need to react the way that I do. I'll just cover off basically 9 or 10 things that are becoming more prevalent in audits of areas of concern, and head off with each one of these with some explanation behind the scenes on it. I'll try not to carry on too much, try and get through this as fast as I can. So I'll be covering off bank overdrafts, the unauthorised accessing of funds, giving financial assistance, the areas relating to residency, the changes of the status of the fund from accumulation to pension mode, then pension back to accumulation, or both, is what's now happening from time to time, the verifying of assets, the valuing of the assets, instalment warrant debt, and the importance of trustees and investment stratagems. So let's have a look at the first area, dealing with bank overdrafts. It's becoming more common now that trustees do not leave sufficient money in their bank accounts to meet all the expenses, including automatic payments such as bank charges. Be aware that under Section 67, an overdraft, no matter how small it is, or even if it's only just for the day, is considered to be a borrowing, and it contravenes Section 67 of the Act. This is termed a mandatory reportable event, and so even though it may only be $1 or $5 or whatever it is, it needs to be reported on what's called a contravention report, and that report is compiled by me and is lodged electronically with the Australian Taxation Office. If the overdraft is seen to be more permanent or is commonly used, the breach will become more serious, and you may in fact eventually lose compliance of the superannuation fund, which has got some really bad outcomes. The next section deals with the unauthorised accessing of funds. In general terms, if a member of a super fund satisfies what's termed a condition of release, they can gain access to their superannuation fund member account. There are a number of conditions of release. Not all of them are linked to the preservation age, or the minimum age that you can officially gain access to your superannuation fund. We need to be careful that in gaining access to our superannuation fund before our preservation age, that we do it only in an authorised way. Some of those authorised manners are known as terminal illness, compassionate grounds, and severe financial hardship. The Act is very specific as to the definitions that are behind those terms of terminal illness, compassionate grounds, and severe financial hardship. A number of boxes to tick and hoops to jump through in order to gain access to your money before preservation age under one of those 3 areas. If you do not meet a condition of release, you're not permitted early access to your superannuation fund money. So please be very careful about what you do in this respect, and probably need to have a chat to us first if you're thinking of doing something a little bit tricky with your super fund, so that you don't come in breach of the in-house assets test or the sole purpose test. These are the most typical breaches that I'm seeing at the moment. One is taking a loan, even if the loan is only for a short period of time and paid back quickly, and even interest is paid, you're not permitted to do that. The super fund buying some asset from you, for example, the super fund buying from you a painting or an investment watch or a stamp collection or something like that, it's not permitted to do that. The fund actually paying some personal expenses, not permitted to do that at all. The fabricating of expenses and seeking unauthorised reimbursement, in other words, putting an invoice in from a supplier for some services of the super fund, and that supplier doesn't exist and the services were never rendered, I've come across a couple of them. Very disappointing when I see that type of fraud occurring. It just shows sometimes how desperate some people's financial circumstances are when they commit fraud against their own fund. Another one is investment into assets that don't exist, with the money then being diverted back to the members behind the scenes, assets being sold and the sale proceeds are not deposited into the super fund bank account. In fact, the sale not even being recorded, and so in the books of accounts assets are being listed as existing when in fact they don't exist. They've been sold and the money's been pocketed. And of course another one is the assets being wrongly scrapped in the books but sold privately by the trustees and the money is kept. Couple more, going on trips to inspect assets, for example, and taking your family along for the holiday. That's a definite no-no. Mortgaging or allowing the assets to be charged as a security for a private loan. And I guess I can go on and on and on. But they're the main ones that I'm seeing cropping up from time to time now. I'm not inviting you to look at these and think that's a good idea and maybe I can gain early access to my fund through any of those. Please don't go down that track. If you are in financial difficulty and you need to access some of your superannuation money you think in order to assist you in your financial difficulties, please contact myself or Heather or Scott before you set about and do anything. Another one is actually the superannuation fund giving financial assistance, not only to you but to one of your relatives. The Act is kind of broad in what its definition of a relative is. Basically there's two limbs to consider within the definition. They include a parent, a grandparent, a brother, a sister, uncle, aunt, nephew, niece, lineal descendant or adoptive child, or a spouse. And then the spouse is quite broad. Who's a spouse? Well, a spouse is also another person, whether of the same sex or different, with whom there is a relationship, or another person with who may not be legally married but lives with the person in a genuine domestic basis in a relationship as a couple. So the definition of relative is quite broad, and so in other words you can't decide to give financial assistance to any of these relatives to help them out either if they're in financial distress, or you can't use them as a third party to get money back to yourself. In other words, loan the money to an aunt or uncle or nephew or cousin, and then they then quietly give the money back to you behind the scenes. That's a no-go. There are a list of common ways that I'm seeing of financial assistance being given. The first one is the straight out giving of a loan. Another one is buying assets and leasing them out. For in other words, buying the car off them, giving them the cash and then leasing the car back to them. That's a no-go, even if it's commercial. Even if it's commercial, you're not allowed to do it. Next one is paying inflated prices for services from the relative. For example, the super fund may own a property and paying inflated prices for repairs or lawn mowing to be done on that property. And the last one is allowing assets of the fund to be used by the relative. The most common is the super fund owns a rental property and the property is being leased out to a child or someone in financial distress, and they're paying a nominal rent, and so that needs to be looked at quite commonly. So that's the end of giving financial assistance section. Next one deals with residency. Basically we have trustees now being transferred around the world and maybe taking up a position elsewhere internationally, may only be for a short period of time. It has serious tax implications, and so as part of your due diligence in determining whether you'll take that overseas posting, can you please make sure you speak to us here at Holsworth Law just to make sure that you're aware of also the impact on your super fund. Some of those tests that we need to look at, there's three big ones with respect to residency. The three big ones are what's called the central management test, the control test, and the active member and residency test. If you fail any one of these tests, just even one of them, even for a short period of time, you definitely will lose your compliance. And the